So here's a number for you. 31 to 1. That was Lehman Brothers' leverage ratio right before it collapsed. What that actually means is, for every $1 this company actually owned, they'd borrowed about $31 on top of it. Some reports say the real number was even higher, like 40 to 1. To put that in perspective, most regular people would get laughed out of a bank for trying to borrow that aggressively against their own house. Lehman Brothers did it with $600 billion. And on September 15, 2008, it all came down at once. The largest bankruptcy in the history of the United States. A 164-year-old company, gone in a weekend. 25,000 employees, out of work by Monday morning. And the man who ran it, he walked away with nearly $500 million in his pocket. This is the story of Richard Fuld and Lehman Brothers. And honestly, this one starts way further back than you'd think. Lehman Brothers wasn't some flashy startup that got greedy and blew up fast. This company started in 1844 as a humble dry goods store in Montgomery, Alabama, founded by a German immigrant named Henry Lehman. His brothers joined a few years later, and the business slowly became Lehman Brothers. By the time it collapsed, this was a 164-year-old institution. It survived the Civil War. It survived the Great Depression. It survived basically every financial crisis America had ever gone through. In 1994, American Express spun the company off as its own public business, and Richard Fuld took the wheel as CEO. People on Wall Street called him the gorilla. Not exactly subtle, but it tells you everything about how he ran things. Aggressive, dominant, always pushing for more. He had this way of staring people down in meetings where he'd just go completely silent. And the silence would last so long that whoever was on the other side of the table would eventually start talking just to fill the void. Usually, they'd end up giving him exactly what he wanted. Under Fuld, Lehman leaned hard into something called proprietary trading. Basically, using the company's own money to make bets and generate profits, instead of just managing money for clients. In 2000, that kind of trading made up 14% of the firm's revenue. By 2006, it was up to 21%. And it worked, at least on paper. From 2000 to 2006, Lehman's revenue grew by 600%. Stock price climbing. Everybody on Wall Street watching Lehman as the success story of the decade. Fuld was on the cover of magazines. He was the guy who took a tired, middle-tier investment bank and turned it into a powerhouse. But here's the thing about betting with your own money. When it works, you look like a genius. When it doesn't, you don't just lose the bet. You lose the company. Starting around 2003, Lehman started aggressively buying up companies that originated mortgages, including risky subprime mortgages, the kind given to borrowers with weak credit histories. And we're not talking about a small side bet here. By the mid-2000s, Lehman was holding tens of billions of dollars worth of this stuff. Commercial real estate, residential mortgages, mortgage-backed securities, all bundled together, all built on a single fragile assumption that American housing prices would just keep going up forever. Think about that for a second. An entire financial strategy worth tens of billions of dollars, built on the assumption that something would never go down. Not might go down a little. Never. That's not a financial strategy. That's a belief system. When the housing market started cracking in 2007, this wasn't just a bad investment for Lehman. This was existential. The value of these mortgage assets collapsed, and Lehman's losses were bigger than the actual cash cushion, the equity the company had to absorb them with. The company was now bleeding money faster than it could stop the flow. Here's the part that turns this from a company that made a bad bet into a company that lied about it. Lehman had this accounting trick internally called Repo 105. Here's how it worked in plain terms. At the end of every financial quarter, when the company had to report its numbers to investors and regulators, Lehman would temporarily sell off a huge chunk of its assets, as much as $50 billion worth, to a separate entity called Hudson Castle. On paper, Hudson Castle looked like an independent company. In reality, it was secretly controlled by Lehman's own executives. The deal was, Lehman would buy those same assets back just a few days later, once the quarter had officially closed and the numbers were already reported. Because of a quirk in accounting rules, valuing the trade at 105% of the cash received let Lehman record this as an actual sale, instead of what it really was, a short-term loan disguised as a sale, just to make the balance sheet look cleaner for a few days a year. Think about what that actually means for a second. Imagine you owe $31,000 on your credit cards, and right before your bank reviews your loan application, you sell your furniture to a friend for a few days, just so your debt looks lower on paper. Then, the day after the bank approves you buy it all back. Nothing about your actual financial situation changed. You just hid it from the one person who needed to see the truth, for exactly as long as you needed them not to see it. That's Repo 105, scaled up to $50 billion. Done by a 164-year-old investment bank. Using this trick, Lehman took its leverage ratio from 13.9 down to a much more comfortable-looking 12.1. Investors, ratings agencies, even Lehman's own board of directors had no idea this was happening. Lehman's own global finance controller would later admit, under investigation, and I'm quoting this directly, "There was no substance to Repo 105 transactions. There was nothing real behind it. It existed purely to make the company look healthier than it actually was, for the few days a year that mattered most." And Lehman's outside auditor, the firm Ernst & Young, who was supposed to catch exactly this kind of thing. They knew about it. They never raised the alarm, even when they were directly asked about it. In fact, an internal Lehman employee had actually sent a written warning to senior management back in May 2008, specifically flagging concerns about the use of Repo 105. That warning went up the chain. The practice continued anyway, right through the second quarter of that same year. Someone inside the company said, "This is wrong," and the people in charge said, "Keep doing it." In March 2008, Bear Stearns, one of Lehman's closest competitors, another major Wall Street investment bank, nearly collapsed entirely and had to be rescued in a fire sale acquisition by JP Morgan Chase, backed by the federal government. The moment Bear Stearns wobbled, rumors started flying that Lehman would be next. Lehman tried to project confidence. In June 2008, they raised $6 billion in new capital from investors, even while admitting their first quarterly loss since going public back in 1994. It didn't matter. Cracks kept showing. On September 10th, just 5 days before the end, Lehman announced it expected $5.6 billion in write-downs on toxic mortgage assets, and a quarterly loss of $3.93 billion. Behind closed doors, things were even worse than the public numbers suggested. Lehman told regulators its liquid reserves, the actual cash it could use immediately if needed, were around $40 billion. In reality, only about $2 billion of that could actually be accessed quickly. The rest was tied up in assets nobody wanted to buy. Imagine telling someone you have $40,000 in savings, but when they ask you to show it, you can only find $2,000. The rest is in things you can't sell. That was Lehman 3 months before it died. By the weekend of September 13th and 14th, 2008, top officials from the Federal Reserve, the Treasury Department, and the SEC were meeting urgently in New York with the CEOs of every major bank on Wall Street, trying to figure out how to save Lehman Brothers before markets opened on Monday. Picture that room for a second. The most powerful financial executives in the world, sitting around a table on a Saturday afternoon, trying to stop a domino from falling that could take down the entire global financial system. The tension in that room must have been suffocating. Hank Paulson, the Treasury Secretary, reportedly told the bank CEOs that the government was not going to bail out Lehman, that they needed to figure it out among themselves. 2 possible buyers emerged. Bank of America looked at the deal and then walked away to buy Merrill Lynch instead, a cleaner, less risky acquisition. The other option was Barclays, the British bank. A deal with Barclays seemed almost certain at one point. People in the room thought they had it. Then, in a moment that still gets argued about today, British regulators, the Bank of England and the UK's Financial Services Authority, refused to waive a rule that would have required Barclays shareholders to vote and approve the deal first. There simply wasn't time for that process. The deal collapsed, just like that, with no buyer, and the US government refusing to provide a bailout the way it effectively had for Bear Stearns months earlier. Lehman had no options left. Early in the morning on September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy. $639 billion in assets. $613 billion in debt. The largest bankruptcy filing in the history of the United States. And to this day, it still is. The Dow Jones dropped more than 500 points that single day. At the time, the worst one-day decline since the markets reopened after September 11th. The collapse helped trigger a financial panic that wiped out roughly $10 trillion in market value across global markets within weeks. 10 trillion. That's not a typo. $10 trillion gone. In weeks. Just days later, on September 20th, Barclays came back and bought most of Lehman's remaining U.S. assets for $1.35 billion. A fraction of what the company had been worth, in a deal the bankruptcy judge approved only reluctantly. Imagine building something for 164 years, and then watching someone buy the pieces for less than the cost of a Manhattan penthouse. Richard Fuld was called before the U.S. House of Representatives Committee on Oversight and Government Reform. Congressman Henry Waxman asked him directly, and this is close to verbatim, "Your company is now bankrupt, our economy is in crisis, but you get to keep $480 million. I have a very basic question for you. Is that fair?" The real numbers tell a complicated story here. From 2000 to 2007, Fuld had taken home roughly $529 million in salary, cash bonuses, and Lehman stock that he sold off before the bankruptcy. By his own account, separately, he said he'd taken in about $300 million in pay and bonuses over those final 8 years. Whichever figure you use, it's an extraordinary amount of money for running a company into the largest bankruptcy in American history. But it's not quite as simple as he walked away rich. Fuld also personally held 10.8 million shares of Lehman stock that, according to a Harvard study, had once been worth more than $900 million. When the company collapsed, that stock became completely worthless. Fuld genuinely lost an enormous personal fortune in the crash. He just happened to have already cashed out enough beforehand to remain extremely wealthy regardless. When the bankruptcy examiner, a lawyer named Anton Volokis, released his findings in March 2010, a report that ran 2,200 pages, he found what's called colorable claims, meaning legitimate grounds for legal action existed against Fuld and several other top executives, specifically over their use of Repo 105 and their decision to file financial statements that left this practice completely undisclosed. Fuld's own defense, both to Congress and later to the Financial Crisis Inquiry Commission, never wavered. He testified that Lehman failed not because of how it managed risk, but because the government made what he called a decision, based on flawed information, not to support Lehman the way it had supported other firms. On the specific question of Repo 105, Fuld testified under oath that he had, quote, absolutely no recollection whatsoever of hearing anything about Repo 105 transactions while he was CEO of the company. No recollection whatsoever. About a $50 billion accounting trick that his own company used, repeatedly, to hide its true financial condition from investors, regulators, and his own board of directors. He just didn't know. Despite everything, Richard Fuld was never criminally charged. No fraudeconviction. No prison sentence. He started a consulting firm afterward called Matrix Advisors. He kept homes in Connecticut, Florida, and a ranch in Idaho. Years later, reporting found he still occasionally called up former Lehman colleagues just to check in on them, ask about their families, see how they were doing. Described by one former employee as someone who, in his words, took the whole collapse very personally. 25,000 people worked at Lehman Brothers when it fell. Most of them didn't have hundreds of millions of dollars already banked. Many of them had their own retirement savings tied up in Lehman stock, the same stock that went from being worth $900 million in Fuld's hands alone to being worth nothing for everyone virtually overnight. People showed up to the Lehman headquarters in New York that final weekend not knowing yet that they'd lost their jobs. Many of them found out by watching the news or by seeing reporters and camera crews gathering outside the building before anyone from management had said a word to them directly. Some employees were photographed leaving the building that day carrying boxes of their belongings, becoming almost instantly one of the defining images of the entire financial crisis. A picture of people walking out of a building they thought they'd retire from, holding everything they owned in a cardboard box. Lehman Brothers survived the Civil War. It survived the Great Depression. It survived world wars, panics, recessions, and a century and a half of American capitalism. What it couldn't survive was $31 of debt for every $1 it actually had, and a CEO who, by his own sworn testimony, somehow never heard a single word about the accounting trick his own company used to hide it. Karma doesn't always show up as handcuffs. Sometimes it shows up as 164 years of history, gone in a single weekend. Sometimes it shows up as 25,000 people carrying cardboard boxes out of a building, while the man who ran the place watches the news from a ranch in Idaho. This has been Financial Karma. If this story moved you, drop a number from 1 to 10 in the comments. 1 if it left you cold, 10 if it made you think differently about the people running the global economy. Subscribe to Karma Unleashed. Every episode, we follow the money and the consequences that never stop arriving. Next time, another name, another empire, another fall. The history of financial karma is far from over, and we will see you on the other side.